Hello and welcome to this spotlight session on AI-driven real assets. My name's Hannah and I'm the head of private credit for Europe at Moody's, and I'll be moderating this session. Over the past 2 years, artificial intelligence has gone from a technology team to a capital allocation force. And what's interesting, at least to me, from a credit and risk perspective, is that much of this demand is expressing itself not through software, but through very physical assets, data centers, power infrastructure, land and grid access. But at the same time, AI is now embedded in several downside scenarios, from AI-led equity correction to stress propagating through private credit and real assets if assumptions around growth or refinancing prove optimistic. So today isn't really about whether AI matters, because it clearly does, but about whether the real risks sit beneath the headline opportunity, particularly for family offices and long-term investors. So on that note, I'd like to introduce Amilcar Krot, who is the Senior Portfolio Manager at Achmea Investment Management and a member of the INREV Management Board. Thank you for joining me today, Amilcar.
Thanks for having me.
Now, if we kind of take it from the top, I suppose, when we're looking at the allocator journey here, a lot of long-term investors will start with largely domestic real estate portfolios, and then they've gradually expanded across borders and assets type and risk profiles. Now, from your experience working with particularly fiduciary clients, how has that journey evolved in practice?
Well, it's exactly that, right? A lot of our clients, when we first interact with them, when we first onboard them, looking at their real estate portfolio, real assets portfolio, it's a predominantly domestic portfolio. And the reason why it's domestic is because the information advantage, they know the market, they know their country. And the reason that they invest in real estate is really for two things, right? It's predominantly income, get that income, and also inflation hedge. But the third thing, and which is oftentimes forgotten, is that the real reason why a lot of our clients invest in real estate is because of diversification benefits. As the portfolio is growing, a lot of our clients are seeing, that there is more outside of the domestic market. They do realize that there is a concentration risk by investing just in the domestic market. They do see the different cycles across the different regions. So there's a natural evolution of just going to a pure domestic portfolio to a more global portfolio. And once that global portfolio is set, they're also considering the operational implications when investing in real assets. And one of these operational complications is when investing in data centers. It comes with additional operational experience that you have to partner with a partner that has that experience. So this journey is really more client-led, going from domestic to a global, more operational real estate portfolio. And as a fiduciary, we help them navigate that journey.
Now, it'd be interesting to hear, how have you found partnering with a fiduciary? Because you obviously get the economies of scale and fee efficiencies. Has that enabled your clients to access more complex strategies compared with investing on a standalone basis?
Yes, definitely. Because a lot of our clients are mid-size, small to mid-size pension funds. And by aggregating their capital, we're able to help them, get better, realize a fee efficiency. By aggregating the capital, we're able to negotiate together with our partners, general partners, fund managers, better management fees, but also better alignment. So it's all about governance, right? It's all about getting them, protecting the client by making sure the governance is in place, proper governance is in place, but also generate better terms. By working together with us as a fiduciary, we're also able to provide them access to managers who are not always top of mind, but who have the capabilities to execute a strategy and to help our clients reach their objective.
And at what point would you say, if you're looking at this from a kind of portfolio evolution perspective, at what point do assets like data centers enter the portfolio? Because, obviously it'd be interesting to hear what would need to be in place, like you mentioned, in terms of governance scale and also client objectives before that step makes sense.
Yeah, that step. So it's really, like I said earlier, it's really the last at a later stage. But once our clients are ready to really, because it starts at an early stage, right? It starts, so as soon as our clients are investing globally, we're following the mega trends. We see a lot of AI headlines, but as soon as they have that scale, they understand the operational issues that comes with investing in data centers, because it's an operational business, right? It's not a passive core investment in investing in data centers, and it also it's crossing the border to when is it real estate and when is it becoming infrastructure. So once our clients are ready to really are comfortable with a global real estate portfolio, are comfortable with a global infrastructure portfolio, that's when we consider more operational heavy assets like data centers. And the most key component there is also how does that align with their ESG objective? Because a lot of our clients have, especially in Europe, are really considering ESG, and it's not just ESG, right? It's also how can we create impact. So whenever we engage with our clients, whenever we know, okay, these are the return objectives, these are the risk objectives, this is our time horizon, we always try to really make sure that we understand the culture, what they're trying to reach with their capital. So it's not just financial returns, it's also what kind of social impact returns are they trying to generate. And sometimes data centers not always align with those objectives. Other times it does, because they do see the mega trends. And for us, it's really helping them navigate that landscape of making sure that they make those investments that align with their objectives.
Very interesting. I think I want to follow up on that ESG point slightly later in the discussion. But before then, I want to pick you up on what you mentioned in terms of classification. I think what you say with data centers is they often sit between real estate and infrastructure. From an institutional perspective, how do you categorize them and where would they sit in your portfolios today?
Yeah, so a lot of our real estate. So if we group them in two buckets, right? So when we classify data centers as real estate, quite oftentimes the external managers that we work with are not data centers experts, but they are real estate experts. They know how to acquire land. They know how to make sure that it's well connected grid. They are well aware of doing everything. So quite often, the way that we partner with them is, underwrite the plan, provide them capital, make sure that they are using that capital in line with that real estate objective. And that's where they are just buying the land, making all the planning, make sure it's well connected to the grid, and then sell it to an operator or to a party that's able to work with operators. Because one of the things that we do have to realize as a real estate investor, when you don't have the capabilities in-house, the technical capabilities, it's better to partner with someone who has that. And quite oftentimes those folks sit within an infrastructure organization. And if I look at when our clients are adding data centers into that infrastructure allocation, it's usually more the core stabilize, the long-term income that is being generated by investing in infrastructure. So that's when it enters the infrastructure bucket. So real estate is really more the development, and infrastructure is really more the period of holding and making sure that everything is in place and that it fits with the clients who are actually using those data centers, right? That's really when it fits within the infrastructure bucket. And that's really the balance that we try to help our clients, pension funds, insurance companies, family offices, try to really help them understand those different risk metrics, and then they can make a decision.
How would you differentiate return expectations and risk budgets and holding periods across those different classifications?
Yeah, good question. Good question. Infrastructure, whenever we do that, it's really, and we do invest in infrastructure and also in data centers. Whenever we do that, it's really more of a long-term horizon. So the driver there is really more income. So we're really looking more at from a core risk profile. If you look at the development on the development side, it's really more value add, opportunistic, so higher returns. That's what we're looking for, and that comes with a short holding period. So short, but it also comes with a higher return risk profile. So it's really balancing those two, and it's really in the portfolio construction when our clients are allocating capital to these different buckets. It's really making sure that we stick to those objectives that are set in the investment policy statement, right? Just making sure that this are we when we invest in data centers, what are the return risk profile that we're trying to aim at, go for, and then we can make the decision whether it's going to be infrastructure or real estate.
That makes sense. I'd be curious to hear, in your experience, where do you think investors would misprice risk because of how the assets are labeled?
It's really the governance, and it all comes down to the governance, because you can have a great plan, but it could be that you're developing, right? You think it's going to be real estate, but you end up in a situation where there is less demand for that particular asset. So it's really making sure that the governance is in place, that you have a plan B, because there could be issues that are not foreseen right now. Another thing that I think, another point that sometimes is mispriced is also the structuring. How is it structured? And when I say structuring, a lot of our investments are not country specific, or really more regional, or sometimes global. And that's when, if you don't work with the right advisor, sometimes things are, it's usually everything is good on paper, but if the governance is not there, if the partners that you're working with are not at that level to be able to execute when things become complex, and another thing that we're really looking for is, do they also have not only the regional expertise, but also to navigate, especially in regions like Europe, where you have a lot of different countries, different jurisdictions. Do they have the local knowledge to navigate that landscape as well? Because one thing is, to set up a fund is one thing, but to also manage that vehicle when things are changing, that regulations are changing. That's really when it becomes important to select the right partner. So we have a couple of partners that we work with, advisors, but it's also, and it's our balancing act as a fiduciary to help those advisors understand what type of clients we're dealing with, because different clients have different needs. That's really what we're trying to do.
Absolutely, and much like you mentioned, I think portfolios are becoming a lot more global. They're becoming a lot more complex. If we tie that into what you were mentioning earlier in terms of ESG and climate objectives, that's kind of increasingly shaping what's investable. But I think what we're seeing is a lot of investors are struggling to reconcile data center investments with things like energy usage and climate impact. So how do you navigate that tension in practice?
Yeah, two things. One, we have to make sure what are the ESG objectives and what are the impact objectives. And I have had several clients who have studied data centers, and because of their climate constraints, have said, okay, for now, the impact, the energy intensive need of data centers do not align with our ESG objectives. So we have had to advise several clients that even though we do see the mega trends, we do see the benefit of investing in data centers. At this stage, given your ESG climate constraints, it doesn't fit. While we also have had others who said that, hey, okay, perhaps we want to invest in data centers, but those data centers have to be driven by clean energy, right? So that's also another balancing act, what we're trying to help them navigate. Some have said, okay, no, we don't want it at all, but others, when the energy is clean and is put in use in an efficient way, they're comfortable also investing in data centers. And I mean, it's a trend that we cannot ignore, right? I think so. Sooner or later, I think it's an asset class that is in need of space, in need of real estate. So I think it will become part of every institutional, whether it's a real assets or a real estate portfolio, it will become part of the portfolio.
Now, kind of beyond, I suppose, minimum disclosure standards, how do you go about assessing whether a data center investment can actually genuinely align with a client's ESG objectives?
Yeah, so we spend quite a lot of time on educating ourselves, right? On making sure that we understand the asset class. And as an industry, the industry has evolved as well. And there is one organization that is helping us assess the ESG impact of these different vehicles that we invest in. And that organization is GRASB, the Global Real Estate Sustainability Benchmark. But besides real estate, they also assess the ESG score of infrastructure vehicles. And we use those reports to really engage with our counterparts, with the GPs. One, we can assess relatively easy the relative score of the different vehicles, but we also can use those reports to engage with our clients, with our managers. I mean, to really understand, okay, where do you get your energy from, but also what kind of governance do you have in place, and also are you implementing that? Because that reports help us to also assess, okay, they have the plans, but are they also implementing it? And what is the energy usage? What is so it's all kind of metrics that help us to assess and underwrite a fund and a fund manager.
Interesting. From a kind of cross-bordering structuring perspective, once an investor moves beyond domestic markets, what are the practical realities of structuring real assets and digital infrastructure investments?
Yeah, I think if you're gonna go global, you also have to have an advisor that is global, but is also local. Has that local knowledge, local expertise, because local the practices can be very different. So, and I think it's really important to work with the right advisor, but also to make sure that the partner that you're working with has also his ducks in a row, right? That there is limited tax leakage, operational complexity is minimized, but it's also important that the partners that you are investing alongside the way with, that they also have the knowledge of investing in such a global vehicle. Because if and then it comes also with, so it's one partner selection, but it's on the other hand, it's also governance. If the governance is not in place, and you haven't thought about worst case scenario, and mix that with partners who are not able to execute in uncertain times, it can cause quite a lot of drama for vehicles who are becoming stuck in a situation and are not able to navigate the market efficiently. So I think that's when it comes about cross-border structuring, it's governance, it's quality of the partner, and it's also really about having that local knowledge, that local execution.
Super, thank you. And as my last question to you, if we're looking into the future here, what would you say distinguishes an investor who successfully evolves their real assets portfolios globally in terms of ESG objectives or technological challenges or balancing scale and fees from those who will struggle as complexity increases?
Yeah, good question. I think from our assessment, we are right now in an AI-driven economy, right? And I think that investors have to realize that real assets are a long-term investment, a long-term business, and as part of a long-term business, it fits within the long-term portfolio. So as investors go along the way, we do have to realize that a lot of these investments in an AI-driven economy are more operational. So we do have to make sure that we are able to underwrite these operational businesses and not just look at the financial exposures. That doesn't mean that everyone has to go and do a PhD, but it's important to partner with the right partners. And that means with the GP, the right tax and legal advisor, but also partner with the right other limited partners. And oftentimes it also helps if you partner with a fiduciary advisor who can help you navigate that complex world outside.
Thank you, Milka. That's very insightful. I think for me, if I step back and try to link this to the broader credit picture, I think what comes through is that AI-driven real assets, they're not a shortcut to growth. They're capital intensive, they're operationally complex, they're increasingly shaped by constraints like power and regulation and counterparty concentration. So it seems like for long-term investors, resilience is going to depend a lot less on capturing the theme, but more on getting the structure, scale, and risk allocation right. On that note, thank you all for joining us, and thank you again to Amilcar, and thank you to Private Markets Group for organizing this session.